Welcome back. You're watching Reporters Diary. Now, Cognizant reported its first quarter numbers earlier today. The management, in fact, the president and CEO Frank is here to take us through those numbers, and my colleague Kritika Saxena will be taking us to that boardroom. Kritika, over to you.
Thanks very much, Nayantara. Cognizant's numbers have come in much better than what they had guided and what the street was estimating. Frank, I'm coming to you now. My first question to you is, on the top line, definitely a much better run than what the street was expecting. So we've seen a growth of around 4.6% sequentially and around 42% on an annual basis. But on the net profit level, it's been slightly tepid with a flattish growth of around 1%. What is the reason for that?
You know, what we're seeing, first of all, we had a very strong quarter, as you said. We're pleased with our performance. And what's really going on with our numbers is reflected in the fact that, you know, North American growth was good. We had a good quarter in North America in the first quarter. But what we're seeing is that in Europe, the recovery in Europe, the economic recovery, is lagging the U.S. a little bit. So we saw that our growth in Europe was a little slower in the first quarter. But we have a very strong pipeline of business in Europe, and we expect that in the back half of the year, Europe will come back nicely.
Okay. Now, coming to your margins, Frank, margins have come in at 20.5%. Are margins sustainable at these levels? You know, in the next 2 quarters, are you hopeful that margins could be beyond the 20+ levels? And is there scope for margin expansion as well currently?
You know, our strategy has always been as a business to operate the company at between 19 to 20% non-GAAP operating margin. We came in a little higher than that in the first quarter, and that positions us well to absorb the impact of the wage inflation that we'll see that starts to kick in during the second quarter. So we expect that in the second quarter, our operating margin will come back into the 19 to 20% non-GAAP range, as we always have. And we don't expect to take it above that because we think that there are plenty of opportunities to invest in our business for growth, and we will continue to invest at that level until the time as we believe that there aren't growth opportunities, which I think is a long time away.
Absolutely. Frank, you know, coming to, can you give us a breakup of revenues in terms of volumes and in terms of price realization? And also, how has the volume performance been in this quarter? You know, last 3 quarters, we've seen a run from most IT companies where volumes were growing by 5 to 6%. But this quarter, for most IT firms, volume growth has been tepid. How has the volume performance been for Cognizant?
You know, I think on both sides, I'm pleased on both the price realization and on the volume growth side. You have to keep in mind that the first quarter is historically a seasonally softer quarter as clients finalize budgets and begin and kick off the year. But having said that, we saw a 2% increase in pricing on-site and offshore. Across the company, that blended to about 1% overall because we had some shift of work from on-site to offshore. And the rest of our growth was volume driven. And so, you know, on both sides, I feel very good that we had a good price increase realization in the first quarter, but also had reasonable volume growth.
Okay. Also, Frank, what is, you know, coming a little bit back to margins, what is the margin level that you've guided for, say, for the full year?
You know, we haven't given specific guidance except to say that we continue to expect to be in our range, our target range of 19 to 20% for the full year, and we're very comfortable to do that.
Okay, Frank, let me just come up into geographies. Can you give us a breakup? Of course, North America is the most important market so far, but we're gradually seeing other important markets, say APAC, say emerging markets, gradually increase in the revenue share, in the revenue pie rather. So can you give us a breakup of how the geography performance has been, aside from just North America?
Yeah, if you look at the first quarter, our growth in Europe was overall was lower than company average. We grew about 1.5% in Europe, and our growth in the markets outside of Europe and North America, what we call the rest of the world, which is primarily Asia, the Middle East, and Latin America, that group of markets actually in the first quarter declined by about 2%. However, if I look over the long term, you know, we continue to invest in those markets. We've been through, over the last 4 or 5 years, a significant investment program in Europe where we've built out local presence across Europe, and overall this has translated into good growth for us over a longer period of time in Europe. And we've now started that same process of investing in the markets of Asia and the Middle East and Latin America. So I expect that over the coming years, if you look at a longer term trend, that the Asian, the Middle East and Latin America markets will certainly increase as a percentage of overall Cognizant revenue as the investments that we're making in those markets start to generate results.
Okay. Frank, also a bit on the verticals as well. What are the verticals currently that have shown traction for Q1 and in Q2, Q3, as far as the discussions that you've had with clients and the kind of deal pipeline that you're seeing? How is the vertical-wise traction looking like to you?
You know, if you look at the story across verticals in first quarter, our growth across most verticals was relatively consistent, with one exception. We saw tremendous growth in the retail, manufacturing, and logistics segment for Cognizant. That segment grew about 13% sequentially, which is very considerable growth. And the reason for that is twofold. One is that you get a little bit of a benefit as retailers in particular come out of the fourth quarter lockdown, where traditionally they don't do a lot of IT work because it's the peak shopping season. Came out in Q1 and we saw a considerable pickup in demand in the first quarter. But I think more importantly than that, the investments that we've been making over many years in consulting, particularly in the retail space, to help our clients understand the intelligent store, form perspectives around the services for the next generation of consumers. These new services are starting to kick in and retailers are starting to adopt, and that's driving our revenue growth.
Okay. Frank, you know, one thing that we've seen across the IT space is the fact that gradually the deal sizes for several contracts that are coming out are gradually reducing. From the deal pipeline and from the deals that you are chasing currently, are you seeing large transformational deals, the TCV deals that we see in the market coming back into favor, you know, the $500 million plus deals coming back? And are you currently, say in the next 2 quarters, are you currently chasing such deals? And can we expect such large TCV deals coming in?
You know, I think that as a general trend, I would say that over the last several years, the average deal size that we've been chasing has trended up, and that continues to be the case today. Today we are chasing large deals that I would say on average our deal size is larger than it was 2 or 3 years ago. I think that the very large mega deals that you saw in what I consider to be traditional offshore outsourcing, rather, those deals are going away because clients in general are moving towards what I call best of breed sourcing, looking at specialized providers for different kinds of opportunities. But overall, for our business, I see the deal sizes increasing, and that continues to be the case. And our pipeline right now is very strong. We're chasing a number of large deals, and I feel comfortable with our pipeline for the rest of this year.
Excellent. Okay, Frank, also, you know, coming to the hiring outlook, your net addition for headcount this quarter was around 7,200 for the full year. What is the hiring outlook that you're giving currently? And also, can you give us some perspective on how attrition and utilization is for this quarter?
Yeah, you know, we don't guide specifically to headcount additions for any year. We added, as you said, over 7,000 people in the first quarter. We took our annual revenue guidance up for the full year to at least 29% year-over-year growth compared to last year. And roughly speaking, you know, headcount grows in line with revenue. And so we would expect that headcount would be roughly grow in that proportion. Utilization, attrition came down in the first quarter compared to the fourth quarter. This is a trend that we've seen for the past couple of quarters, so we're pleased by that. And utilization dropped a little bit as we rebuilt our bench in anticipation of demand for 2011. I expect that utilization will go up a little bit, but, you know, sort of bounce around at this level. We're comfortable at this point with where our utilization is. It's within a band of where I think is reasonable to run the business.
Okay. Also, Frank, a bit on your wage hikes. From what is the quantum of wage hike that you'll be giving out across onshore and offshore employees, and, you know, what percentage or how much would it impact the Q2 and Q3 numbers?
Yeah, you know, we finalized our wage increases in the first quarter, and they go into effect mostly in the second quarter and then to some extent in the third quarter. In India, we expect very healthy increases in line with what our competition is doing. We expect that to be in the range of 12 to 14%. And in our on-site markets around the world, the range there is in the low single digits increases, obviously varying market by market. We think that, as I said, that this will have some impact on margin in the second quarter. It will bring our margin back into the range towards the high end of the 19 to 20% range on a non-GAAP basis that we traditionally run the business in. But we feel very comfortable that given margin was strong in the first quarter, that we can absorb that and still be towards the high end of the 19 to 20% range in the second quarter.
Okay. Frank, coming to your guidance for the full year, you're expecting around 29% growth. You're expecting to touch around $1.45 billion. Now, what are the key areas that you're expecting to be levers to drive this growth? And also, can you give us an outlook on how the price realization and volume would be? Of course, you don't specifically guide that, but can you give us an outlook on how it could be in FY12?
Yeah. So let me talk about the color of demand as we see 2011 unfolding. This is a very interesting time for clients. We see clients really focusing on two different sets of mandates. We are, at this point in the recovery cycle, our clients are focused on innovation and growth, looking at things that are going to drive their top line and allow them to take advantage of the opportunities in their markets. And so there's a lot of work that we're doing through our consulting group, for example, that we've been building over several years. Our management consulting team is now 2,500 people. Utilization levels, bill rates in that business have gone up. Our pipeline in that business has never been richer or stronger than in the past. And so we feel very good that we are positioned well to serve clients on innovation and growth topics. At the same time, the recession has not faded from people's memories. People are still very focused. Clients are still very focused on efficiency and effectiveness, making sure that they're running efficiently, lean and mean. And so what we're benefiting from that as clients look to move ever larger and different tranches of work to a global delivery model. So our businesses, for example, our BPO business, we've seen some good wins in the last couple of quarters. We've announced a few, for example, with Eli Lilly, with Volvo Cars, where we're taking on different kinds of BPO work for those firms. And so we see, sectors, services like BPO, like IT infrastructure services, benefiting from this trend as clients look to move more to a global delivery model. So we feel very comfortable that we have a portfolio of services, both on the innovation and growth side and also on the efficiency and effectiveness side.
Okay, Frank, one last quick word from you. How significant is the currency volatility right now? Do you see that impacting revenues in Q1, Q2? Just a quick word on that.
Yeah, I think that what we see is that the economic recovery in the U.S. is well underway. That we see clients focusing on growth and innovation. We think that the economic recovery in Europe is lagging the U.S. By a quarter or two, but we think that that's also well on its way, and that Europe will be back to what I think of as a more normalized growth towards the back half of this year.
Excellent. Thank you so much, Frank, and congratulations for touching the 29% growth in FY12. So, Nayantara, like you heard Frank point out, the outlook for Cognizant is looking good. They have guided much higher than several other IT peers. So, of course, let's wait and watch out to see how the next couple of quarters turn out. For now, the outlook is looking very good.
And of course, Kritika, also it's very important that the company is sticking by its guidance of growing by 29%. We're going to see a wage inflation coming up in quarter two, just the way Frank was pointing out, but he feels the company is in a comfortable position to really absorb that wage inflation and still report operating margins in the high 19 to 20%. And also the good news coming in from Cognizant that the take inflation head on, breaking away from its middle and more calibrated approach. The RBI and its credit policy today raised some key rates. In fact, the RBI's Deputy Governor is joining CNBC TV 18 for an exclusive interview. So let's cut in live.